When stock prices fall sharply, it often raises questions about what drives the movement. Behind the scenes, a specific trading mechanism can accelerate these declines. Today, we are breaking down how this mechanism works, the logic behind it, and the risks involved. Welcome back to Finance Files. We've explored value investing and risk management, but today we are looking at a market mechanism that often makes headlines: short selling. This is an educational overview. By the end of this video, you will understand the mechanics of borrowing shares, the math behind the transaction, and the extreme risks that can lead to infinite losses. Section 1. The borrowing game. How it works. Normally, you buy low and sell high. Short selling flips that order. You sell high and buy low. But how do you sell something you don't own? You borrow it. Your broker lends you shares from another investor's account. You immediately sell those borrowed shares at the current high price, pocketing the cash. Your only obligation is to cover your position later by buying the shares back and returning them to the lender. If the price drops in the meantime, you buy them back for less than you sold them for. Section 2. The logic of the bear: when to short. Why would someone take this risk? Short sellers, often called bears, look for companies that are overvalued, facing a scandal, or have failing business models. While the rest of the world is caught up in the hype, short sellers look for the cracks in the foundation, like the revenue accounting tricks we discussed in our previous deep dive. However, the math of a short loss is uniquely dangerous. When you buy a stock, the most you can lose is the price you paid. But when you short a stock, the price can technically rise forever. This creates a scenario known as a short squeeze. If a stock price unexpectedly spikes, short sellers rush to buy back shares to stop their losses. This wave of buying can push the price even higher, squeezing the shorts and compounding their financial damage. This is often the precursor to the massive volatility we see in the news. Section 3. The danger of the short squeeze. The math of a short loss is uniquely dangerous. When you buy a stock at $10, the most you can lose is $10. The stock goes to zero. But when you short a stock at $10, the price can technically go to $100, $1,000, or even higher. Your potential loss is infinite. This leads to a short squeeze. If a stock price starts rising unexpectedly, short sellers panic and rush to buy back shares to limit their losses. This massive wave of buying pushes the price even higher, squeezing the shorts and leading to a total financial meltdown for those on the wrong side of the trade. This is often the precursor to the massive volatility we see in the news. Section 4. Famous shorts in history. The Big Short. We've seen this play out in the real world. During the 2008 housing crisis, a few investors spotted the house of cards and shorted the entire mortgage market, making billions while the global economy collapsed. More recently, the GameStop squeeze showed what happens when retail investors band together to fight back against institutional short sellers. These events highlight the high-stakes nature of short selling. It is a high-speed game where the underlying math can lead to financial ruin just as easily as it can lead to profit. It is a high-speed game where one wrong move can wipe out an entire portfolio in minutes. It can provide liquidity and expose overvaluation, but it carries a risk profile that isn't suitable for investors. Short selling is a mechanism that introduces both liquidity and volatility to financial markets. Understanding how it works is a key part of financial literacy, regardless of whether you agree with the practice. I want to hear from you. Do you think short selling should be legal, or is it a predatory practice that hurts the market? Let's have a civil debate in the comments. If you want to keep understanding the complex mechanics of finance, hit that like button and subscribe to Finance Files. Keep learning, keep questioning, and I'll see you in the next file.